Welcome to Breaking News to Trading Moves. Today we're focusing on a single transaction, one involving Honda and LG Energy Solution. We're going to look past the headline number to understand what this really means for the auto supply chain and the whole electrification effort.
Exactly. And this transaction, it's not just an accounting move. It's a clear signal about strategy. Specifically, it points to the need for direct control over key assets, like battery production, as the market sort of adjusts to what consumers want.
Okay, so let's get into the details of what actually happened. The main story is that Honda is buying about $2.86 billion worth of assets at a battery plant in Ohio.
Right, from a joint venture partner they have with LG Energy Solution, it's a huge capital commitment. It really shows that Honda sees this facility as absolutely mission critical.
That's it. Honda's U.S. unit is buying the factory building and the related assets. But there's a really crucial detail here. The deal specifically excludes the land and any equipment that's already there.
And that exclusion tells you a lot, doesn't it?
It does. We're talking about the shell, the building itself, not the ground it's on or the machinery inside.
It's a fascinating detail. LG Energy Solutions said the goal was to improve the joint venture's operational efficiency. But by holding onto the land, LGES keeps some long-term leverage, maybe a leaseback deal, or, it gives them options for future expansion that might not involve Honda.
So it's more of a surgical reorganization than a clean break. Honda gets control over the physical space, the walls, the roof, which is what they need to set up their own production lines quickly.
And LGES is very clear that they are not exiting the joint venture.
Right. Production is still set to start next year, but the ownership structure has really changed in Honda's favor.
And that brings us to the bigger picture, the strategic context. Because this isn't just about Honda and LG. It's about a trend across the whole sector. Why would an OEM, which usually outsources something this complex, suddenly buy the building?
Right. It seems like a big risk to take on.
It is. But they're taking on that risk to get more direct ownership of the battery manufacturing footprint itself.
I understand the point about managing costs. But wouldn't taking on all that manufacturing risk be incredibly expensive? Maybe even slower than just buying finished batteries from a specialist like LGES.
Well, that's the new calculation they're making. Outsourcing can be fast, yes. But you give up control over cost, quality, and flexibility. By owning the factory, Honda gets a direct say in managing costs. And more importantly, they can make sure the production ramp-up matches their vehicle launch schedules perfectly. They're choosing control over just getting a promise from a supplier.
And this all seems to be happening against a backdrop of a changing market climate. We know the industry is reevaluating things right now. There's slower than expected consumer demand for pure EVs and some ongoing policy uncertainty.
Exactly. And that combination means that those rigid EV-only timelines, a lot of them are being put on hold. Automakers are favoring what you could call flexible powertrain strategies. In that world, this transaction is all about creating options.
Options? How so?
Honda commits to the long-term infrastructure by buying the asset, but they're not forced to produce only EV batteries immediately. They can use that factory to support hybrid production for now. It gives them a buffer.
Okay, so that idea of optionality, being able to pivot, that seems to define the first group of beneficiaries we can identify here.
That's the first theme, yes. OEMs that secure battery control are gaining strategic optionality. If the market stays tilted toward hybrids for the next few years, companies with secure battery assets and flexible plans can adjust their product mix on the fly.
So they can meet today's demand, but they're still ready for tomorrow's electrification goals.
Precisely. And the companies that are well-positioned for this are the ones with strong hybrid offerings already.
Like Honda Motor, that's ticker HMC, and Toyota Motor, which trades as TM.
Yes. They're seen in a positive light because they have that buffer for what might be an uneven transition.
Let's move to the second group of beneficiaries.
Yeah.
The U.S. battery materials and supply chain. Why do they win here, even if the pace of EV adoption is a little slower than planned?
It's about creating a demand floor. Think about it. Once an OEM like Honda puts down nearly $3 billion for a factory, that factory is going to need raw materials.
Ah, okay, so the spending has already been committed.
Right. Even if car sales are a bit inconsistent, building these large domestic battery plants creates long-term demand for inputs, especially lithium. The physical supply chain has to follow the capital.
So the materials suppliers benefit from the factory commitment itself, not just the short-term consumer behavior.
That's it. And that helps stabilize the outlook for major lithium producers. We're talking about companies like Albemarle, ticker ALB, and Lithium Americas, which is LAC.
All right, the third group of winners falls under what's often called the picks and shovels side of the market, factory electrification and automation.
Yes, and the logic here is pretty solid. Battery plants are incredibly demanding facilities. They need huge, specialized electrical systems for all the power they consume and very sophisticated automation to ensure quality.
I suppose that's true no matter what you're building, whether it's a gasoline engine or a battery. You still need that high-tech power and control infrastructure, right?
Absolutely. And when an OEM like Honda takes direct control, it often speeds up that spending. They'll want to put in their own standardized, state-of-the-art automation lines. They want that facility running to their exact specs as fast as possible.
So that need for quick implementation benefits the companies that provide that industrial backbone. The analysis points to companies like Eaton, ticker ETN, and Rockwell Automation, which trades as ROK.
They benefit from that immediate need for facility upgrades and new instrumentation.
Okay, now let's turn to the other side of this, the groups that face more difficulty as the market adjusts.
If flexibility and control are the winning themes, then the companies without those advantages are facing some headwinds.
And we can start with the most exposed category, the EV-only automakers.
This market, where the move to pure EVs is a bit more cautious and hybrids are getting more attention, it creates a couple of real challenges for them. First, the pricing environment gets a lot tougher. When the big OEMs are pushing competitive hybrids, it puts immediate pressure on the EV-only makers to lower their prices.
And I imagine it also affects how investors see them, if growth forecasts get a little cloudy.
Investors get nervous. When the market lowers its expectation for how fast EVs will take over, it can compress their valuations and make it more expensive to raise capital. They just don't have the revenue from other products to fall back on. They're all in on one path, and that path is currently facing some speed bumps.
The companies that come to mind here are Lucid, ticker LCID, and Rivian, RIVNN.
Their projections really depend on a very aggressive, straight-line adoption of EVs, and that's now being called into question.
The next group facing pressure would be the public EV charging networks. This seems like a direct consequence of that hybrid tilt.
It is. It's a very simple mechanism.
If you buy a hybrid instead of a full battery electric vehicle, you just don't need a public fast charger nearly as much.
That's the core of it. If consumers put off buying a full EV, then the growth in charger utilization, which is the key metric for these businesses, could lag behind those earlier, more optimistic forecasts.
And their entire business model is based on getting to a massive scale and high usage rates very quickly.
It is. To justify all the capital they've invested, a slowdown in BEV adoption puts a direct strain on those models.
So that would affect companies like ChargePoint, ticker CHPT, and EVgo.
And finally, we see things getting tougher for independent battery startups.
Now, why is that? If the long-term goal is still electrification, are they just getting frozen out?
It's not so much about being frozen out, but more about a loss of negotiating power. As OEMs like Honda take more direct control over the factories and the timelines, the environment for smaller, independent developers gets a lot more demanding.
So when Honda owns the factory, they're the ones who dictate the specs, the timeline, everything.
Correct. So a startup, even one with fantastic new solid-state battery tech, suddenly has to try and sell into this very highly controlled system.
They lose their leverage.
They do. And that can mean a much longer, more difficult path to reaching any kind of meaningful production scale, which is life or death for a startup.
And the analysis points to companies like Solid Power, SLDP, and Air4YR Battery, FREY, as facing these kinds of challenges.
Ultimately, the common thread for all these challenged groups is their reliance on a pace of pure EV adoption that just isn't happening as quickly as everyone thought it would.
So that brings us to the main idea you should probably take away from our conversation today. This one transaction shows how the whole electrification supply chain is being reorganized around optionality and direct manufacturing control by the big automakers.
Exactly. So when you're watching the market, you should probably focus on who have that flexibility, who is supplying the raw materials, and who's providing the automation to build out these factories.
That focus on optionality seems key. The operational leverage that comes from having physical control of battery assets gives them a buffer that the EV-only makers just can't match right now.
That ability to pivot, to make hybrids today and then scale up EVs tomorrow, that is the premium strategic asset in the auto industry at this moment. That flexibility is what the market is rewarding.
A great analysis. Thank you for that guidance. Before we conclude, please note, this is not financial advice or buy or sell recommendations. This is purely the opinion of the author.